call, so there's going to be a little bit of repeating myself at the beginning, but we want to make sure that everybody's on the same level playing field as far as in case we have some new annuity purchasers or new folks just getting used to annuities. So brief overview is an annuity is basically a contract between an owner and an insurance company. So the owner being you, an individual, family member, whatever the case may be, and the insurance company. And all of the claims in annuity contracts are backed by the insurer's capability to settle those claims with you. So the advantages, certainly an advantage for our clients, is the tax advantages that go along with owning an annuity. Time in a tax deferred manner, such as an IRA account, can be a great advantage for folks. Really, they're designed to combat two things. As we transition over to different types of annuities, we laid out 5 traditional, commonly selected annuity options that are out there in the marketplace. And we've sort of arranged them from the lowest risk possible to the highest risk possible in terms of just what you can buy out there. So historically, over the past 7 years, Blueprint Income has made a marketplace really revolving around 2 products, and those 2 products being income annuities and fixed rate annuities. I'll start with income annuities first, in case I know there's some MIGA buyers on here, but an income annuity can be an important piece to a retirement puzzle as well. So income annuities are extremely conservative in nature. Really what they're designed to do is they're designed to allow an individual to eliminate risk on themselves and transfer that risk to an insurance company. And what I mean by that is a lifetime income stream. So pensions have sort of died off. I'm sure a few of our folks here on the call today have a pension, but this is sort of a way to create your own pension using your own either non-qualified or qualified funds to create a lifetime income stream that you cannot outlive. So really, when you look at those, there's 2 main differences. You have a SPIA, which is a single premium immediate annuity, and then you've got deferred income annuities as well. Deferred income annuities, long story short, is just a vehicle that starts a distribution after 12 months, whereas a SPIA would be a distribution that starts anytime in that first 12 months of the contract. The second most common, or I would say really is probably the most common annuity form, is a fixed rate annuity or a MIGA. So the way a MIGA is designed is it's designed very similar to a CD, whereas the purchaser of it guarantees a particular rate internally in the contract and a particular term. And I apologize, I'm getting some feedback. Hopefully everybody can see. Ricardo, are you able to see the screen?
No, I can't. Can you try again to share? Otherwise, I can share the.
Sure. Sorry, guys, for the interruptions. Technology is always the laggard here. Yeah, Ralph, as a moderator, if you want to go ahead and share your screen and then you can click through, that would probably be the best. Sorry, guys.
All right. Hopefully you can see my screen now.
All right, is everybody good right there?
Yep, that's good.
All right, awesome. So we'll just move forward with the slide there, Ralph, just discussing the different types of annuities. So back to the MIGA, and sorry for the interruption there, but the MIGA contracts really, as I was stating, are kind of like a CD. So you're just buying a guaranteed contractual term, and they're promising you a guaranteed contractual rate. So what that allows folks to do is it's a repeated asset building source in your retirement years. Most of the sales that occur on blueprintincome.com or the solutions we provide for clients do fall into that MIGA range of just contractual guarantees. If we go to the other end of the spectrum, traditional variable annuities, I hear this statement all the time when I get on the phone with folks, and it really revolves around, I've heard annuities are expensive and there's risk of loss, or I haven't made a lot of money. Most people that bring up those topics, unfortunately, either sold a variable annuity without a complete understanding of what they're buying, or they weren't aware of the fees associated with a traditional variable annuity. I promise you, working with variable annuities, they're not all bad. There's a different flavor for every different customer. A traditional variable annuity may not be right for you, but maybe a 50-year-old husband and wife that are planning for their retirement, utilizing an income rider product in a market-linked contract, that may be the right thing for them. So again, that's why we have options. Not everything is going to appease every single buyer. On the other side of that, and also a product Blueprint Income does not offer, are registered index-linked annuities, most commonly referred to as RILAs. So RILAs are very similar to fixed index annuities. One of the major differences between an FIA and a RILA is RILAs do have some downside participation. So as we're going to discuss later on, fixed index annuities are a great way for principal protection to exist, along with upside and market potential. RILAs take that one step further, in instances allowing more market participation. The difference is you're also taking a gamble on the downside that if the S&P is negative for a few years in a row, you could have an adverse effect to your cash value. And then what we're really here for tonight is the index annuity piece, the fixed index annuities, allowing an individual in retirement some upside potential that they normally couldn't receive on a MYGA, CD, or other fixed product, but complete downside protection as you move through your retirement years. And Ralph, if I could get perfect. So just a quick overview, and then we'll get into the different moving mechanisms of a fixed index annuity. But as we had stated earlier, complete protection of principal over a period with the potential of a higher return than, say, a MYGA or a CD type product. So how it really works, and for those MYGA buyers out there, you'll totally understand this. The start of the selection process is the same. You're going to choose a term, typically somewhere between 3 to 10 years, more so 5 to 10 years in index annuities. And then you're going to select an underlying index as well. So where this starts to become different from a MYGA than a traditional fixed index annuity is the allocation piece of the investment. So one of the best things about an index annuity is the ability to put assets or money in different buckets of the contract. Two of the most common, and we're going to cover, I believe, 4 of the most common today, are indexes such as the S&P 500. So many of you will know that markets are generally tracked by what the S&P 500 does, because it's a very broad-based index of what's actually happening in the stock market. Each year, account values change in the fixed index annuity based on income performances, or if you've selected a fixed return account in your investment vehicle as well. But again, no downside to these contracts. Really, your downside is not making money in that given strategy in that given year. And then at the end of the contract, the exact same as a MYGA, you've got a litany of options of whether you would like to annuitize, whether you would like to keep the contract there and accept the renewal rate that the insurance company is offering you, whether you want to do an IRA transfer or a 1035 exchange to defer taxes down the road. Everything's at your disposal. You can even cash out at the end of that term if you'd like to. So a couple of things that at face value, and I've been talking a lot with folks that have come to blueprintincome.com and trying to learn a little bit more. The biggest hurdle to get over on these products is they're pretty simple in nature, but there's an extra step when you buy one that you're going to have to elect how you want the money invested. Excuse me. So in the index selection, there are always going to be multiple options depending on the product. We've already covered the most common being the S&P 500. What you'll find sort of around the industry is the S&P 500 tends to be the most commonly used benchmark in this, especially in a model where you, the consumer, are making the choices versus a wide range of different available options. But there are other indices to take advantage of, which I think is really great as well for the consumer. Again, options are beautiful for us to have. So what you're looking at is additional options such as the Russell 2000 or different small and mid cap indexes. And then we also have some in particular products that have custom indexes that you actually cannot have access to them unless you're in some type of a fixed index annuity. A lot of those revolve around market volatility indexes, Some revolve around different sectors of the market that, let's be honest here, if you're on an annuity webinar, I think we can all consider ourselves conservative investors at this point. There are industries that sometimes folks would like to have access to, but they can't afford to take the risk in that particular sector in the market. An index annuity would be perfect for an individual like that, looking to accept more risk for more return, but your risk really boils down to making nothing for any given year. And then crediting options that you can use, I mean, fixed accounts and indexes that you select, they all have a particular way that they accrue the asset. So a hypothetical example, and we're going to go over it in our next slide, is you could use any form of a cap rate, a participation rate, a performance trigger tied with that index to actually grow your wealth.
Jay, can you speak about the difference between using an index to credit your account in the context of a fixed annuity versus being invested in the market? Because those are two very different things.
Absolutely, and that's a great point. And I think we're going to cover a lot, but a real quick snapshot. So for those unfamiliar with the fixed index annuity, you are assigning your money to track an index. However, you are not investing in the index itself. And that's really where your principal protection comes from. The insurance company is buying options to cover your return based on what the returns on the S&P 500 are for that year. You as a consumer, though, are getting the money to an insurance company and then electing to track an index. So there's actually no physical investment or risk in the market. You're just tracked against that index. And I hope that, clears a lot up for people that it's still a fixed product. So we're not intentionally flipping it in the market and seeing what happens. We're basically taking a starting value of whatever index you select on the first day of the contract, and then reviewing that either 1 year in advance or 2 years in advance to see what the gain or loss for crediting purposes in your annuity is. But on the next slide, the most common index allocation option that is selected in these contracts is a traditional cap rate. So how a cap rate works, and when we were building this presentation, I would love to have a PowerPoint on a 90-foot screen that showed 25 past years of performance and be able to show those. We could definitely show those to you in another time if you want to schedule a call, but we really stuck down two options here to explain how cap rates work. So I went through and gathered return performance information data on the S&P 500 for 2021 and 2022. Now, unless you've been living in a basement somewhere, which I feel like I do sometimes, 2022 obviously was an incredibly volatile year because we've had a spike in interest rates. So if you look at the MYGA market and the fixed index annuity market, rates have been really high. However, market performance has been extremely low. So utilizing as a hypothetical, an example of allocating in the S&P 500 point-to-point strategy, which is the cap rate, and we used an average cap rate of 10%. I don't like when I go to these, seminars or these webinars or these calls, and you have a producer standing in front of you showing you a 15% cap rate and it never ends in all this glory. We want to kind of cut through all that and create a baseline of realism of what to expect. So on our marketplace today, we have 10 contracts. The median 1-year cap rate on those contracts is 10%. So that's how we're coming up. That is a real tangible number that you can divide it. So how a cap rate works is the insurance company assigns you that 10% cap rate. That is the most that you can make in that 1-year period in that contract. So hypothetically speaking, if you were to invest that money January 1st of 2021 for that 1-year period for that cap rate, the S&P 500 was up 26%. So what the insurance company would do is they would credit you up to your cap, which is 10%. That number would lock in, and then you would renew in a new investment strategy the next year. So great, right? We make 10%, no risk of loss beyond that. The market made 26, but I didn't deal with the volatility of the market. Everybody's happy. Fast forward to 2022, we have an environment that is much different. S&P 500 for the years down 19%. We still hypothetically had our 10% cap rate. We absorbed no loss. Now, it's not always going to be picture perfect in this scenario. However, if you do some market tracking over years and you go back to 1990, which I think is a reasonable basis, the S&Ps had 7 negative years. Now, we can't take history as, this is what's going to happen in the future, but a lot of that is the reality of how these products were designed. Is they're designed really to track market indexes to allow people upside. So even if we go back, those 34 years with 7 years of losses, the average loss in those years was actually over 15%. So for a lot of our conservative investors, you can position this in your portfolio as either a bond alternative, or you could position it as a market alternative for a percentage of your portfolio that will keep you as an individual invested. And we've all heard that story. The hardest part of investing is people try to time. This is a product that affords you the capabilities to not have to time. This is going to keep you in the market. You're going to stay in. You'll take the highs and lows, but your low is 0 and your high is somewhere around 10 to 11%. And as we move on to the next common, and we'll take questions. Yeah, go ahead.
Yeah, Jay, before we do that, we have just a quick question about the definition of qualified versus non-qualified. Can we address that before we move on?
Absolutely. So so here's the way I teach folks at Blueprint Income to think about this, and it's the easiest way to track it. So qualified means pre-tax. So when you look at a qualified account, such as an IRA account, a 401k account, a 403b account, those, and it's really easy to relate in the brain. If you see qualified, I like to think of it as qualified tax status with the IRS. So you have some sort of advantage on that money, whether it's grown tax deferred or whether, for an example, it's in a Roth. There's a little gray area there, but just think qualified is non-cash for purposes of tonight. Non-qualified being cash in a checking account, cash in a savings account, cash in a CD, just any liquid form of cash that's already been taxed. So non-qualified already been taxed, qualified pre-tax, except for Roths. And we'll go into the second most common used strategy in these products, which is a participation rate. Same thing here. We've used real live data to kind of capture what a realistic participation rate is. And what you're really looking for when you're looking at index annuities, you're looking for something between a 50 to 60% participation rate. So applying that, which can be found on our website, a 60% participation rate, those numbers 2021, again, 26% upside on the S&P 500. We're capturing 16% of that because the insurance company is paying us 60% participation of that index's return. Now, to make this really simple, if there is an index option, so S&P 500, Russell 2000, across the board, most products are going to support a cap rate versus a participation rate. Now, I get the question very often, which one's better? It really depends. And really, it depends on a variable that's hard to calculate. It really depends on the thinking and the market movement. So as an example, if the market's up 30%, most of the time it would have been better to have a participation rate. That's really hard to judge. So that really comes down to working with either myself, someone at our company, or an agent that you work with to decide in a given year, is it better off to use a participation rate type product, or is it better for me to use a cap rate? The nice thing about these contracts is year to year, you can go back and forth. So if the first year you're in a cap rate type alignment in your contract, the next year you could always transition to a participation rate, or you could blend the two together. And the same thing applies on participation rates on downside protection as well. You're not going to really be in the business of losing money in this contract, so it would just be a flat return of 0. And Ralph, if we could scroll down more.
So one just
Sure.
to summarize before we go into the writers. In summary, the premium that you are investing can go into 2 types of buckets, right? The fixed guaranteed return, which is very similar to a MYGA, where there's a rate that doesn't change with market conditions. You can put a % of that premium in that bucket on a fixed index annuity. and then the rest of it you can allocate into these index-linked allocations that they will work basically defining with two variables, right? The first variable will be you need to choose the index that can be S&P 500 or others, and then you also choose how that index will be used to credit interest to your account, and those are the two more usual options, the cap rate and the participation rate, to define how your annuity will be credited based on these indices. Let's talk now about the riders, but before that, let's address a question here. How does an immediate annuity compare to a fixed income return?
Perfect, and that's a great question. So we get that a lot daily here at Blueprint. So an immediate annuity or a SPIA is basically annuitizing a value. So to explain that a little further, when you buy an immediate or an income annuity, essentially what you're doing is you're giving the insurance company a lump sum of money, and in return, the insurance company is guaranteeing you a monthly benefit. So what ends up happening in that transaction is you lose control of your cash value. So let's just say, for hypothetical purposes, you give an insurance company $100,000, they're going to guarantee you an income stream of $8,000 a year for life. That, hypothetically speaking, that's how it would work. There's no ability. Now, some contracts do have some ability, and I'm definitely glad to talk through those. But for the most part, 90% of these contracts, once you make that investment into that income annuity, that's it. You're getting a check. And that check will go for a certain period of time, or that will go for, covering two spouses for the rest of their life. So I like to think of it, again, as a pension, which is the easiest way to wrap your mind around it, that once you take that pension payment, there is no cash value figure in that pension. You're getting a check for the rest of your life. Whereas a fixed income return would be like a fixed rate, where you're not actually receiving the money personally in the form of a distribution. They're crediting your account a certain fixed amount of money per year. And even in MIGAs and FIAs, a fixed account actually credits daily. So the difference really is just the utilization of the cash value. In a fixed rate annuity or a fixed income return annuity, your tax deferred growth internally in a contract, you're not necessarily taking distributions, even though you could. And in an immediate annuity or SPIA, you're transferring risk to the insurance company, longevity risk, that they will continue to pay a check for the rest of your life, regardless of how long you live. But that's a really, really good question. So, and that's a good question as well. So we have a quote tool that is actually live rates on our website for income annuities. So depending on how old you are is going to determine the mortality table in which your annuity is priced. So take me, for an example, being a much younger individual. My income payout is going to be much, much less than a 65-year-old. So we encourage folks to go out to blueprintincome.com under income annuities. It's going to ask you some brief details about who you are. So date of birth, dollar amount, whether that money's pre-tax or post-tax. And then the screen will automatically populate real live quotes that you can lock and apply for. Generally speaking, based on a mortality table, and I'm just doing this on a rough age, if you were 73 to 74 years old, your payout percentage would probably be somewhere in the realm of 9% currently. So you'd be looking at a break even of around 10 to 11 years. And then Mr. Patel, income annuity for the rest of life, what happens if you die? So there's some customization that you can do internally in an income annuity. So there's such a thing, and I don't want to drag it too far, but there's such a thing as return of premium at death. So say you enter into an income annuity contract, walk out your front door, bus shows up a little early, you get hit by it. The return of premium at death, what that would allow you to do is whatever money you didn't take, they would return that to your beneficiary. Now, let's just say hypothetically in that scenario, if you lived 20 years, you took more than what you actually put into the contract would just terminate. Perfect. And I appreciate, keep the questions coming. We'll have a Q&A at the end as well. But just a brief overview. So benefit riders. So this may be new to some MYGA purchasers from the past. So MYGAs, for the most part, although a lot of them have liquidity features internally in the contracts, which allow interest as it's earned or a 10% free distribution annually. Fixed index annuities actually do the same, but they do offer living benefit riders. The simple way, and we're happy to run illustrations for folks after the call tomorrow, next week, whenever you'd like, to show you how living benefit riders work. Essentially, what a living benefit rider does is it's a blend between an income annuity, which you're annuitizing, an accumulation vehicle like a MYGA or a fixed index annuity. So for a fee, and I'm going to stress that the fee is listed at the bottom. We have really nice disclosures from compliance, which I love. Your average fee is going to be somewhere between 0.6% and 1.5%. And what it does is it gives you a growth component internally in the contract and a set income percentage rate at whatever age you decide to start taking withdrawals. One of the advantages of this is particularly for people between the ages of, let's say, 55 and 65, if their wish was to take income at 70, they would have a guaranteed roll up for future benefit values component. And then they would have a set income percentage that would be calculated on that benefit amount, but then removed from their contract value. The best part about this is the guaranteed roll up of the benefit, and then the ability to access cash value in the event that you would need it. Now, we all know, for the most part, that annuities do have suitability. So you should have liquid assets after the purchase of an annuity. But this is just another backstop for folks that they have a living benefit rider, they need living, lifetime income, but they also want to have access to a cash balance while it's available. It's a perfect scenario for folks like that. And also, too, as you get older in age, obviously mortality goes down. It could be a good decision instead of annuitizing at 80, 85 years old to purchase a living benefit rider to keep that cash value intact for beneficiaries and other purposes. Because what you have to understand, you are taking a distribution, but from an income stream, but you have the ability internally in the contract to make up for that distribution using your cap rate or a fixed rate. The other side of it, and really when I wholesale, there was a lot of interest from folks and advisors and clients of death benefit riders that are normally not associated on MYGAs. So standard process in a MYGA is that if you pass away, a death benefit is whatever the account value is. So index annuities have riders, and this is pretty common in the industry today, that will allow a guaranteed roll-up for death benefit purposes. So regardless of what your cash value does, for a fee, the insurance company will give you a certain percentage, usually between 4 to 7%, towards future death benefit needs for a certain period of time. So the death benefit will remain intact for you until you're required to annuitize. And that's usually a much further date, usually over 100 years old. So it'll allow you to accrue that death benefit on a guaranteed basis while still accruing your asset in its contract value. The number one use for this that I've seen in my entire career is uninsurable people as they get later in life. So a common client for a product like this would be somebody that is legacy planning to gift, but they are no longer able or can receive life insurance. As you know, as well as I do, a lot of insurance type things, long-term care, life insurance gets put on the back burner during life, and sometimes we can be a little uninsured. This is a way to help make up that gap. And I think we had another question. What is the average return on a fixed index annuity? So I get this one all day long. Long and short answer, it depends. So really, in a cap rate type allocation in a fixed index annuity, the easiest way to sort it out, and I think we can probably send something out about this, Ricardo, if it's really wanted, is you could track S&P 500 returns historically based on what cap rates are today. So it's not a guarantee because the cap rate is dependent upon positive performance in the index itself. But you can look at historical values, like when you make any investment, and take the trade-off of, over the past 7 years, if I was in this average cap rate, you can get an idea of the potential. There are fixed accounts, as we discussed, and we're actually at a really good slide for this question. So this is an example from blueprintincome.com on our website of what the actual contract would look like. So as we had stated earlier, we were using a cap rate of 10%, which in my opinion, with where interest rates are right now, is pretty conservative. Now it is high versus historicals, but it's pretty conservative. And then you've got fixed rates that tend to be a little lower in these contracts because they're giving you the upside of the cap rates and the participation rates. So long story short, your average return, and through industry articles and LIMRA, these contracts really target to make somewhere between 4 to 6.5%, depending on duration. I would say on a 10-year duration product, 5 to 6 would, I hate to use the term conservative, but I'm going to use the term conservative. I don't 10% every year. There's going to be ebbs and flows, just like any market related product. But really, that's the pushback once in a while. Well, why wouldn't I just do a MIGA? Well, interest rates always haven't been here. So if you look back, if you were a fixed annuity buyer 3 years ago, I don't know. Sorry, guys, I got lost there. But so in fixed accounts, you can guarantee a rate. Long story short, I'm happy to schedule time and we can do some analysis together of what that potentially would look like. And we had a question from Mr. Bartlett. Since the principal value of the annuity is not FDIC insured, can you discuss how the credit ratings are determined for specific companies and how insurers provide protection to clients in the event of an insurer becoming insolvent? So great question there as well. So MIGAs and fixed index annuities and income annuities all get lumped into what's called a state guarantee association. $250. Did I lose you guys there, Ricardo?
Yeah, Jay, we lost you for the whole explanation there. Any chance you can find a location that you have a little bit better Wi-Fi?
Yeah, absolutely. If you want to elaborate on the list there, the website view, Ricardo, just for a second, and I'll be right back, guys. Okay.
Yeah. Just addressing the point about FDA insurance products not being FDIC insured. All the contract terms are backed by the strength of the insurance company. The strength of the insurance company is typically measured by rating companies that will give a rating to each based on the assets, how their investments are performing, and other variables like that. The one that we use the most is AM Best. That's the one that you can see across our website. So the stronger company will be A++, and then we go to B+ or B++ as a lower rating. We don't have any company lower than that on our marketplace. And then the other part of the story is the state guarantee funds, where on a given state, insurance companies have this fund that will kick in case an insurance company becomes insolvent. There are limits to them. They can be dependent on each person, or they can be by contract, by person. It really changes state by state, and you can go to their website to see the specifics. But there's a limit that they will cover. There's also a process in which if a company goes insolvent, there's a process for them to recover, or to have another insurance company taking over the contract, and otherwise the state insurance funds will kick in. There you can go into the website of the state guarantee of your state and see the details about it. There's typically a Q&A that explains in a lot of detail what are the limits, and if it's by person or by person and by contract. So I encourage you to check that. So that will be sort of a second layer of defense there.
Yeah, and we got a question there as well of am I being too conservative, going with A minus or better? The case at all. I think there's a different rating, and there's a lot that goes into AM Best ratings. A lot of it can be segmented out to what types of insurance solutions that a company sells, along with, obviously long-term financial strength pieces, short-term financial strength pieces, where money is being reinvested to cover contracts. But it's really good to look at financial ratings, and a lot of it I like to look at depends on the claims paying ability of the type of contract you're buying. So at Blueprint Income, for our income annuities, because they tend to be longer dated in nature, because they're contractual lifetime guarantees, we recommend staying A or better. We think that A minus companies could do just as good of a job as well. But when you're talking about long-term guarantees, look, the safety of our consumers is our most important principle as a company. We have those restrictions for a reason. If you're doing a 3 to 5 to 7 year duration type of investment, we have those B++ and A minus companies available. Think of it in terms of, it's insurance companies are very stable, but you can think of it in terms of investment grades of bonds. Can work very similar. Obviously, especially in the short term MIGAs, the lower a rate is or rating is for a company, generally in the short term contracts, the higher their interest rate will be. And we can move on to the next slide, Ralph, because I want to leave some time for questions. But I also had a question pop up that I thought was a very, very good one, which was, is it true that annually can they change the renewal rates on these policies? Yes, that can happen. What you want to be careful looking for as a consumer, if it looks too good to be true, it is. So on blueprintincome.com, there are products out there that do, have 14, 15% first year cap rates, 12, 15% bonuses. We don't offer them because we don't believe in the renewal rate history will be able to back up those initial upfront offerings that they're providing you. So the most important thing on the index annuity side, you want to work with a good company with a good financial rating and good renewal rate history, which we can definitely help you with if that's something you go to look for when you purchase one of these. So one of the last segments here, so we can get to some more questions, is key features as we discussed. Complete principal protection, which is what our customers come to know from blueprintincome.com. And then upside based on an index performance like the S&P 500 or Russell 2000. Fixed accounts are available for guaranteed growth if that's how you want to allocate your contract, which can always be a good idea. Riders are available for a fee. Those living benefit and death benefit riders included in that. And like I had stated, most of them are between 0.5% to 1.5%. Items to consider. So an index annuity can be researched from an individual and then purchased by themselves. We always stress that if you have any questions or concerns, to please give us a call. I can walk you through any of these contracts that we're offering currently on our website. And we really want to make sure you're getting the right thing. Back to the growth potential, as we've been reminded, growth potential isn't guaranteed. The only guarantee in these contracts is if you were to elect a fixed account, which generally the rates on the fixed accounts in these products are a little bit lower in comparison to MIGAs because of the upside potential you have with other options. Crediting options can change at the end of interest crediting terms. So that's in relation to cap rates that can fluctuate year to year. We like to stay with high quality companies that have good renewal rate histories. And we also have a few contracts out there that do have buyout provisions. In the event that they would lower a rate to a certain extent, you have free liquidity to leave the contract. And then on our website, not as much, but as we continue to go down this path with our consumers, there will be from time to time some index accounts that do have a fee. It's not something that they can add after the fact. This is just upfront. There could be indexes that have small fees. And a lot of times these indexes will have fees because they'll give you a higher upside than what's offered without a fee. So at this point, we'll take some questions. I know I've got time. I don't know the exact time on me, but I think we're fine. And then the only thing I wanted to highlight is, so I actually do all the scheduled calls for Blueprint unless I am for some reason not in the office. I encourage you to schedule a call with me. We're a very low pressure educational forward company. We just really want to do what's right by you and get you into the right solution. So I know there's some customers on here that I've helped before, and we really appreciate you guys attending tonight. But yeah, any questions would be great. And we've actually got one there. I've seen participation rates greater than 100%. How is this possible? So if you see a participation rate greater than 100%, it's never going to be aligned with the S&P 500 ever. It's going to be in either some sort of managed volatility index that we can provide literature for as well, if that's a product you look at. But those are generally custom indexes that are designed to manage volatility in both ways. So they have a little bit more runway to provide 100% upside with no downside. So very good question. But again, I'm always going to reiterate, and I don't know everything, but I like to think I know a good bit. If a rate seems too good to be true, upon renewal, you'll probably find out that it was. Thank you, Peter.
About the question about the maximum state
Good.
insurance in California. If you Google state guarantee insurance California, you will get in the first result the State Guarantee Fund Association website with the limit for California. I don't remember off the top of my head, probably 250, and it's 100% insured up to that limit. There are some states that they have a percent. Maybe California is one of them, to be honest. But happy to take that offline and provide an answer. But you can find it in Google very, very easily.
So Raj, and another good question to that point. So it would include capital plus growth in MIGA. So what we'll see routinely with some of our clients at Blueprint is they will actually, if they start to get close to the insurability limit in their state, they will start to actually take distributions to remain under that limit. And we had another question too, and I'm trying to, I'll come back to it. I got to scroll through here. I think it was from Mr. Patel. That was per policy per life. So this is another thing on the state guarantee website that you want to look at. The 250 is kind of a stock stated people use. Every state can be a little different. And in fact, some states do per policy per owner. So that's definitely something you want to check because at the end of the day, you could get around a lot of those limits by diversifying between multiple companies. Because as we all know, if there's a competitive fixed rate, somebody else probably has something very similar. So there's always going to be an option. So the next one I have here is point-to-point pros and cons. Happy to take this on a scheduled call. Really, the pro of it is the upside potential using the point-to-point strategy and being able to lock in the gain every year. Because as we know, you can change allocations year to year. The point-to-points tend to just be the most popular. One reason they're pretty easy to understand. And two, generally speaking, the highest earning potential that you have in these contracts does derive from the point to point. A downside is with a point to point is you could go a year or two in a row without making money. It really just depends on the index that point to point's tied to. We got the kind of rate change for fixed annuities. So in a fixed annuity, a MIGA, it's a contractual guarantee. So once you buy it, your rate's locked for the entirety of that term. In an index annuity, as we've stated, you have higher upside. There can be some renewal rate adjustments, but again, that's why you want to work with companies that have strong renewal rate history and are in the business of backing those contracts that were initially sold. The worst thing you want to do is offer somebody a contract at 10% year one and the contract be having a cap rate of 4% in year two, which we're very mindful of. And then, has anyone lost money on their annuity due to an out of business? So you can go back in time. I am familiar personally, but I've only, fortunately, didn't work with the company. I'm only familiar with one pure life insurance company actually going through the State Guarantee Association claim process. To my knowledge, now this is where it gets a little tricky. So there's a difference between an historical life insurance company and a property casualty company. So as you can imagine, smaller property casualty companies that service folks down in the southeastern part of the United States that experience hurricane season every year, there have been a number of solvency issues in relations to those companies. Historically speaking, in insurance companies remain pretty stable. And the fact of the matter is, a lot of these situations, and you don't want to guarantee this, but a lot of the situations, if a company does get into some type of a oversight or rehabilitation from the state, there's a lot of acquisitions that take place in those. So I can answer that as yes, I'm sure somebody has lost some amount of an asset due to a solvency issue with a company, but that's why those state guarantee associations and the client has to make with the agent the best judgment on how much to place with a certain company. So tax treatment, Mr. Macco, and Ralph, if we run out of time, if you could just kind of nudge me, I'll just, Ricardo, if you're good with it, I'll just keep rolling through a couple of these.
We still have 10
So
minutes.
tax treatment on non-qualified accounts, really what it comes down to is it's fully tax deferred while in the annuity, even if you have an annuity that comes to, it take 10 minutes, perfect. So even if you have an annuity that comes to maturity, as long as you don't take a distribution to your pocket, so think IRA account. If you take a distribution to your pocket, you owe on taxes. An annuity works the same way. So as long as the money remains invested in some sort of an annuity, either a fixed annuity or an index annuity, you can continue that tax deferral to distribution. So once you take a distribution, the distribution from the non-qualified account would just be ordinary income taxes at whatever your federal and state brackets are. So do joint owners on the same contract have double the coverage? So I knew we were going to get a lot of State Guarantee Association questions because I get a lot of them on a daily basis. Those are, so when you're in the business of soliciting annuities, which is selling, you can't basically popularize the idea of the State Guarantee Association. It's best to let you know that it is available in your state. And for any question that goes into the differentiation between states of State Guarantee Associations, it's really in your best interest to call the state because that's who you would be working with in the event that you had to file a claim.
Yeah, and
Mr. Bartlett, appreciate your time and effort. Webinar. Oh. Yeah.
So sorry, we have some we have an article on our website that Ralph put in the chat there with information about it. And we should probably think about doing a webinar that addresses this question because I think it's an important one. It's true there are limitations on using this as a promotion for annuities, but I think that given the questions, we'll take this as feedback, as maybe something that we can share more about. So just wanted to say that, but also refer you to the education piece that we have on our website and that Ralph included in the chat.
Yeah, and John Macco had a question for commissions for FIAs. So great question, often asked. So the nice thing about insurance contracts insurance contracts in general and through blueprintincome.com is the commission does not come from your purchase payment. So we have selling agreements in place with the insurance companies where our distribution model, if you buy a fixed annuity or an index annuity through blueprintincome.com, they pay us for the distribution of that product. Generally speaking, across the board between MIGAs and fixed index annuities, commissionable payouts to us range anywhere from 0.5% to, they can get as high as 5, depending on the products. Income annuities and fixed index annuity contracts, because the durations are longer, generally have more upfront to our pocket, but commissions on these products in reality are pretty low, and there's no fees to you as well, which is a good feature to have. Next one, and I think the last question I have on here is, do fixed annuities have to go through probate? They actually skip probate. So if you name somebody a beneficiary on your fixed annuity policy, the process would be the insurance company would require a date of death and a death claim form to be filled out, and any requirements they would need, but it's generally a pretty quick turnaround time to pay the claim. They would just mail a check to the beneficiary.
We do have a couple of raised hands.
Sure.
William, did you want to ask your question?
And just so you're aware, you are on mute, Mr. Wise.
Can you hear me?
I can.
Yeah, I was interested in knowing the process in terms of investing in a fixed annuity, in terms of the actual purchasing of the contract. Is that like two-factor identification, or how does that process work?
Hey, Ricardo, I'll actually let you take that one, because I think you're a little more on the tech side than I am.
Yeah, so this is so just to be sure, is the question about the process of buying annuity?
Correct.
How
If I want to buy a fixed annuity, I have an IRA that I'm thinking about rolling over the first of the year because it's maturing in a CD. So
Yeah.
I'm thinking about maybe rolling that into a fixed annuity for 5 years.
Right.
So
Yeah. So basically, the way it works is that you will complete an application for the annuity. The
okay,
application is online, so it's available on our website, and it's pretty easy one. Actually, we have a new experience that should make it even easier. And after that application is signed, we prepare a document that you finally signed the application. Make sure that everything is it's correct, and you are agree to send the application to the insurance company.
okay,
Then that application is reviewed by the insurance company, and if everything looks good, you will fund the annuity. So depending on the source of the funds, it will be a check that you mail directly to insurance company. We never touch the money, or it will be a transfer of assets in between companies. If it's a CD, very likely will be either a wire or just mail a check. And then once the insurance company has received the funds, they will issue the contract, and you will receive most likely a paper copy of the contract with the details. And in general, these companies will have a client portal where you can see your balance, and keep track of it. So it's a relatively easy process that we are here there to help you in terms of if you have questions with the application or keeping track of the process until you have your policy issued.
roughly what's the time frame in terms of getting that completed?
So I can actually take over that one, and again, I'd be glad to help if anybody on this call ever needed help with an application. But time frame depends on the insurance carrier's availability to process quickly. So how many current incoming applications they have, and the most important point of that is the funding source. So
Okay,
over the past year, there has been some pain felt in the industry as far as an understaffing between insurance companies and the amount of volume. we're getting back to a better situation. So hypothetically speaking, if it was a cash purchase that was pretty straightforward, you'd be looking at processing time of anywhere between 10 to 14 business days, but they would mark
Okay.
back the effective date to whenever they receive the money, which is good for you because it's not your fault they're behind. On transfers, you could be looking at anywhere between 3 to 5 weeks. And I use a conservative estimate there just because it could be longer, but we have a system that makes Blueprint a very valuable resource. Is when you apply with us, you're going to get an advocate per se, or a case manager that's going to work with you for every requirement, start to the finish.
Sounds good. Thank you very much.
Thank you
Thank you
for
for
your
the
time.
question.
Appreciate it.
We also
Um,
have some from
yeah.
Woods Parker, who also raised their hand.
In the meantime, about scheduling a call, if you go to blueprintincome.com/call, you can schedule a call with us. You can choose the day and time that work for you, and we'll call you at that time.
Yep. Sometimes I can be 2 or 3 minutes late. I'm going to apologize in advance right now. I'm usually on time though. So if you schedule a call, I look forward to speaking with you. And Woods, if you can unmute your mic, if you have a question, be glad to help.
I believe they posted it in the chat as well. So if
Okay. Yeah, if you can find it, that would be great. And Matt's in Austin. Does your website allow us to look at particulars of these FIA contracts in some detail? It definitely does. I'm always, again, going to push to the scheduled call function if you're looking at these index annuities. And even to the extent we can provide some sample contracts and go through them with you. I'm a little bit of an annuity nerd, so believe it or not, I've read through a lot of these contracts. So if there's some sort of language you're looking to see, I can definitely get that over to you on virtually anything that we offer on our website.
Wood's question was, if a MYGA is annuitized, is it possible to specify a term to receive payments, or is the default lifetime?
No, so absolutely. So the most common options, if you're annuitizing a MYGA, would be really there's a lot. It could be a 5, 10, or 20 pay. It could be a lifetime payout. It could be a joint survivorship payout, depending on the original structure of the MYGA. That is actually all embedded in your contract when you receive it. And then that would be information that we could get you ahead of time in the event that you were thinking about annuitizing a contract. There's always well, I can't say always on anything, but there's more than likely the option to create a term that fits your schedule the best.
And we also threw the link in there for schedule a call. It's just blueprintincome.com/call if you want to schedule a call with Jay.
All right, so I think we are on time. Thank you so much, everyone who joined. Hopefully, it was a good opportunity to learn about annuities. Happy to continue the discussion with Jay on a scheduled call. So please do that. And yeah, hopefully it was helpful. This is the first one that we do. We are planning to do more. So if you have any feedback, we will really appreciate it. And with that, have a good night, everyone. Thank you for joining us.
I really appreciate everybody joining. As well as a quick note, the lifeblood of our business is having consumers shop and educate around annuities and eventually purchase annuities. So it's not lost upon our entire company. If there's something that we can do for you that benefits your situation from an educational piece or a product selection piece, please reach out, because without you guys, we're not here. So much appreciated.
And also, we recorded this webinar, so if you want to share this with friends, family that want to get a little bit more educated on annuities, by all means, we'll send it out so it'll be shareable and you can share it with anybody you like. Thanks, everyone.
Thanks, guys.
Thank you.